Some considerations, though, about insurance within superannuation. One is that income protection insurance, that the premiums, if they're outside of super, they're tax deductible. So if you're on the highest marginal tax rate, sometimes it can be beneficial to hold that outside of super. Generally within super, the payment period, so if you are ill and are unable to work and it triggers your income protection policy and starts paying you 75% of your salary, it will only pay for 2 years within Christian super, whereas policies outside of superannuation can pay up until age 65. One strategy you can implement is have you cover within Christian super for the 2 years, and then have a cover outside of superannuation with a waiting period of 2 years that will pay till 65. So then you're basically getting a cost-effective, comprehensive cover. You can get agreed value outside of super, where it's indemnity value within super, and there's a fixed waiting period of 60 days with Christian super at the moment. I think they are considering whether they change that over time to make it more flexible, but that's what it's set at the moment. With death benefits, there are tax implications. So what happens if you die is that the insurance provider will pay out the amount to your super fund. So say, for example, it's $1 million and it's paid into your fund. If you haven't got a financial dependent, but your super is going to be passed to, say, adult children that are not financially dependent, then they could effectively end up paying 31.5% tax on that money. So there are some tax implications there as well. And similarly with TPD, you could actually trigger your TPD policy under the insurance criteria, but within the superannuation fund, you might not satisfy the criteria, and so you might not be able to get the money out of your super fund in terms of a lump sum. So there's a couple of things to consider there, but generally superannuation is an effective way to provide for your insurance needs.